It's freezing out there. I'm sure you agree with me. It's really cold. Hopefully it warms up here towards the end of the week as we move into February. But boy, it's been a bit of a brisk last few days here in Boise land. As we go towards spring, though, we sure hope to see things warm up, and not only in the temperature, but also in the housing market. There's a few things that indicate that that could be happening. We have, of course, on the horizon, as I've mentioned in previous videos the last number of months, potential for lower interest rates as the year-over-year inflation numbers continue to soften and come down. Of course, the Federal Reserve is meeting tomorrow. You've probably seen that in the news. And then what they're doing is, of course, the market is anticipating that they're going to increase the overnight federal funds rate by 0.25% tomorrow, which is in line with expectations. So the market has pretty much priced that in already on the bond market for rates as well as the stock market. If there's anything outside of that, that would be considered extraordinary, and markets would react kind of violently accordingly. But at this point, it looks like that is what we expect to see on the February 1st a meeting, an announcement that's from the Federal Reserve, where they started meeting today and should announce by February 1st, tomorrow, Wednesday. So looking forward to that on the horizon. Other things that are newsworthy or that you shouldn't be aware of: there are various manufacturing indexes throughout the country: Philadelphia, New York, Kansas City, Dallas, around the country that focus in on manufacturing sector and how that's going as far as the activity in manufacturing and orders. Those orders have been slowing in recent months. Over the past 6 months, 9 months, they've continually become weaker. The index numbers have become weaker and weaker, which points to a potential recession happening soon here this year. So we'll see what happens with that, of course, as we move forward. Inflation continues to come down. Fed last Friday, there was an inflation index that came down year over year, month over month, for that inflation number, the core index, and that, of course, is friendly towards interest rates. So anytime you see inflation improving year over year or month over month, it all points to lower interest rates, because inflation is the archenemy of interest rates. So outside of that, I mean, there are, of course, other newsworthy items. The job market appears to be showing some cracks. This has remained incredibly strong, of course, all the way through. However, the last jobs report indicated that the vast majority, almost all the job gains, were part-time job gains, which coincides, of course, with the holidays, etc. And there are many companies who are not laying off as many workers as they might have in a normal recession, but at least reducing hours. So many people making or working less than 32 hours a week at this point. So all these things are indicating that we could see a recession come very soon. We'll be keeping our eyes out for that, of course, as we move forward. Recessions generally indicate lower interest rates as well. So, hey, things are set up to where this could be a decent spring buying season, unless it becomes a deep recession where people are afraid for their jobs and afraid to spend money. But as long as it's just a shallow recession, we should see a pretty healthy, balanced market for real estate this spring. So let's dive into the charts. I'll show you what's happening. As you can see on the top here, the Universal Mortgage-Backed Security, the UMBS, is up 13. This is the price. Again, when the price goes up, that means the rate and yield are dropping. So that's an improvement slightly. And the 10 years dropped 5 basis points, which puts it down to 3.5. And that's a good thing. When that yield drops, that means rates are dropping. So let me show you here the chart itself. This is the mortgage-backed security chart. And as you can see, we've been in this range, for the last 2-3 weeks, since the beginning of about the 9th or 10th of January. We've been stuck in a range. It's been a fairly wide range, about 40-50 basis points, but which is about an 1/8% swing in interest rate either way. But it's still stuck in this range of Fibonacci range here on the top as a ceiling, and then on the bottom, of course, a 25-day moving average, and then the 50-day moving up to support that. So there is quite a good support level here that could indicate that as we continue to get hopefully positive inflation data coming out and other data that indicates inflation is easing, we could, over the next few months, see this break out to the upside at some point and give us slightly better interest rates again. So far, so good. It's been behaving itself the last 3 weeks, but still, if you have a client that's closing within the next 3 or 4 weeks, it's not a bad plan ever, of course, to lock in an interest rate and so they can sleep better at night. And I recommend that, unless somebody really wants to gamble it. But at this point, it's been a fairly stable range. Things can change in a hurry, though, at some point. And when we get new data, hopefully it's positive towards interest rates. I'll show you the 10-year Treasury here real quick so you can see that. 10-year Treasury chart, of course, is the opposite, it's the inverse of the mortgage-backed securities chart. So as the yield drops, rates are dropping. So we've seen a nice drop, as you can see, since the beginning of the since the end of November, beginning of December, and we've steadily seen an improvement, right, in yields. So being down around the 3.5 range is a very wide range here, but there's plenty of room still for the 10-year Treasury to continue to drop even lower down to this next Fibonacci level, and even pierce it and go below it, like happened about 2 weeks ago. So at any rate, we'll be watching the data. Right now, we're a little bit range bound, giving some measure of stability to interest rates. Again, fluctuating maybe only an 1/8% up or down over the last few weeks. But as things change, I'll be in touch and go forward and share that information with you. In the meantime, if you have any questions, would like to visit with me about anything you see here or anything you hear coming out of my mouth on these videos, feel free to reach out to me. Email, call, text. My office number is 208-939-0002, and would always welcome a call from anyone, and visit with you about that. We of course are moving forward to the spring season with our $10,000 underwriting guarantee at Summit. Just want to remind you of that. That's a great way to be prepared for you or your clients if you're a real estate agent. But if you're in particular looking for a house and want to have the best possible negotiating power, our $10,000 underwriting guarantee will give you that. And I'm happy to explain that in more detail if you'd like. In the meantime, have a wonderful day.